To get proceedings underway, I will now call on the Chairman of the Pensions Authority, David Begg, to address you. David.
Good morning, dear friends. You're all very welcome. Delighted to see such numbers here at the conference. Very, very encouraging for us in the authority. I want to particularly welcome the Minister, Derek O'Leary. I'll introduce him properly in a few minutes, but we're delighted to have him with us this morning. So David has talked a little bit about the purpose of the conference. I suppose just what I'd say is this. We published our statement of strategy there in July when it was approved by the Minister, and it's on the website. But I think what we want to try and achieve today is to explain our general approach and to get down into the weeds a little bit more and outline what we're doing and what our expectations are, specifically in relation to forward risk-based supervision, which really, from the regulatory point of view, is quite a sea change, as you know. I think the problem with pensions is that apart from, unless you live in the pensions world yourself, it's quite a boring subject, or at least it is until you reach 50, where it becomes sort of vaguely interesting. By 60 it becomes riveting, and at that point it's nearly always a little bit too late to do much about it, unless of course you're very wealthy. But the CCPC report that was published earlier in the week was probably some concerning statistics about the direction of travel. Although, to be honest with you, our own experience is that there is a growing interest and a growing involvement in occupational pension schemes and in PRSAs. So I don't know quite how to reconcile the two, but perhaps it has to do with the fact that, as you know, Ireland has a rapidly growing population, and that may account somewhat for what appears to be a decline in involvement. But anyway, like the Pensions Authority, as you know, has a statutory remit in the 1990 Act and its various amendments since. But generally speaking, we work also within the framework of the Pensions Roadmap, which the Department published a few years ago. And when you look at the current landscape for occupational pensions, I suppose you could say, on the one hand, certainly the defined benefit scene is a lot better than it was a few years ago. Like good, strong performance of stock markets and the performance on interest rates and bonds has actually helped with liabilities quite a lot, I think. So most are in a reasonably good state. But having said that, we have to also bear in mind that the growth, the big spike in inflation over the last few years has really hit, fixed income people in a fairly hard way. There's been an increase probably about 20% in the cost of living. And the problem with that is the cost of inflation may go down, but the cost of living tends to stay where it is. On the DC side, we have made very good progress. We're very happy with the progress we're making with consolidation. And at this point, I want to acknowledge the cooperation which we have received from the industry and from all those people who are involved in pensions. It really has been very, very good indeed. And we've been able to make progress more than, we perhaps expected that we would be able to do. The introduction of auto-enrolment as well, I think, will certainly help enormously with the coverage side of things, although we have to be practical and acknowledge that it will be a long time before it addresses the adequacy pension. Here, this morning I saw in the English papers that the Institute for Fiscal Studies in the UK, talking about auto-enrolment, said that, at this point in time, most people retiring would, 40% of them, at least not most of them, but 40% of them would face a difficult retirement situation. And that's bearing in mind that auto-enrolment has been in the UK for quite a few years, and the member subscription rate is now up to 8%. Now, I only mention that in the sense I do think auto-enrolment is a great move forward, but we can't be complacent about it. There's a danger that we think that, okay, that's great, pensions are sorted, that's the end of it. But I don't think that is the case. I think there's much more work to be done. So looking forward anyway, I will just note a couple of points. I think that in a European context, pensions will assume more of a systemic importance than they have for a couple of reasons. The first is geo-economic. The fact that capital markets are now much more important in Europe and that people are very much interested in trying to get the the wall of pensions money, as it were, invested in European industries, not flying off to the United States. I think that financial stability will also be a consideration. And there was an article in the Financial Times there a few weeks ago worrying very much about what would happen to bond markets when the Dutch pension reform kicked in. And of course, it's moving from DB to DC, so the traditional reliance on bonds to deal with liabilities wouldn't be there, and that would have a potential effect on the bond market there. And I noticed also some additional urgency yesterday. Mario Draghi was saying that he was very disappointed in the lack of progress that was being made in Europe on the implementation of his report, that of the 383 of his recommendations, only 11% had been implemented. So I think that, as I say, the geo-economic situation will bring its own imperatives, and I think we'll begin to see some changes there, maybe a more intrusive approach to regulation, perhaps in the future, I don't know, but I think that's a possibility. The second issue, I think, of systemic importance is demography and the increase in the dependency ratio, the old age dependency ratio, because we are an aging population, and on the other end of the spectrum, fertility rates are dropping, so arguably in the future, population size will plateau at some point, albeit that it is growing at the moment, mainly I expect through immigration. But I think that brings forward some issues on the DC side. Once the DC becomes the dominant formula for pensions, we have to start looking not just on the accumulation side of things, but on the decumulation side as well. Because you have to remember that a person may have a substantial, if they have a substantial lump sum when they're retiring, there are a number of risks that they have to start to take into account. The longevity risk, you don't know how long you live. If you thought you were only going to live for 5 years, you might say, let's have a world cruise every 6 months and live it up. On the other hand, if you lived for 20 years, that could be a little bit problematical. There's the sequential risk, the sense that, okay, in the early, retirement can usually be broken into 3 phases. The first phase where you're in relatively good health and you can do all the things that you wanted to do. The second phase where your health is not so good and you kind of have to stay put. And the third phase when caring in old age becomes a real consideration. So that is a hard enough challenge to navigate for somebody who doesn't have investment experience. And there's also the fact, of course, that when we get older, cognitive decline begins to set in and it becomes much more difficult. So what I'm really saying to you, good colleagues, is this, that looking forward, I think we need to turn our minds to more innovation on the DC side so that we can produce better products than there are at the moment. We all know about annuities, but that's not a great market. There hasn't been a great interest in it, and I think it's well worth thinking about how things could be made better in that sense. And what I'm saying, I suppose, is that I think basically there are a much deeper set of issues to be looked at in the future than even those which have been adumbrated in the CCPC report this week. And pensions reform, it's a difficult area. I just asked the French and they'll be able to tell you. But it's something, nevertheless, that we have to get to grips with in the future for the reasons that I've set out. And when we met the Minister, Brendan and myself, a few months ago, we did say that maybe at some point in time when auto-enrolment is on its way and so on, maybe it would be a good time to start thinking of pensions roadmap 2, perhaps, and we could begin to delve into some of these issues. So at this point, I'm delighted to introduce Minister Dara Calleary. He has a very wide brief. He's not just responsible for social protection, but also for the Gaeltacht and for community development and rural affairs, which is a very wide brief in itself. But he's a minister with a huge range of experience over the world, over his career. He's somebody for whom I have an enormous respect, and I'm very glad indeed that it is somebody of his calibre who is at the helm of social protection at this time of challenge and great possibilities for the future. So my great pleasure to introduce Mr. Dara Calleary, TD, the Minister for Social Protection.
Thank you, David. Good morning, everybody. I'm delighted to be with you this morning. Excuse the hoarseness. I'm taking a break from the ploughing to be with you For those of you who are from abroad, just ask your Irish counterparts what the ploughing is to understand it. But we've been at the ploughing all day yesterday, we'll be again today and tomorrow, sending the message of pensions and of auto-enrolment, and I'll speak to that later. But I want to thank David and Brendan and all the team at the Pensions Authority for not just putting this morning together, but for their work in this space. And you got a sense from David how much command he has of the issues and of the challenges that he's facing. And it's a heavy agenda for the day, so to keep you engaged, I want you to see if you can identify the 26 letters of the alphabet in the various acronyms that are going to be used. And if you can, you might get a prize at the end of the day. But it is very acronym-based. But as David touched there, and as Brendan and the team will later, all of you have within your control and within your day jobs the futures of so many people and so many families at your hands. And the discussion around pensions, I think David put it up really well, tends to be one that we all put our head in the sand about until it becomes a major challenge and a last-minute issue. But what David has set out there in terms of the challenges of the future are something we are engaged in. And obviously our focus immediately is on auto-enrolment, but he has set a challenge to me previously in regard to a pensions roadmap too, and that's something we will look to. Auto-enrolment is happening at long last, 20 years later. My Future Fund is our name around it, and that will commence from the 1st of January. I just want to thank the team in the department who are putting enormous work in. And we have over the summer raised the profile of My Future Fund as a brand and as an initiative. And it was actually interesting yesterday at the ploughing, in the department stand at the ploughing, there was engagement, there was considerable engagement from employers looking to what their responsibilities were. But from talking to the team that were there all day yesterday and talking to them late last night, there was quite considerable employment from parents about their young student children, would they be a part of auto-enrolment? So that was something that was really interesting in the conversations around it. We're moving into a new phase of the information, which will be more hard-hitting, more bringing it home to people what's involved. That's very much the information and the public information side of the campaign. And as we move towards the budget phase and a budget which will be delivered now in less than 3 weeks, auto-enrolment of My Future Fund will be a major part of those post-budget analysis in terms of where people's incomes will be at for 2026. So I know there is a lot of scepticism. We've had false stalls before, but ladies and gentlemen, the show is arriving and it will happen this year. We have awarded the 3 contracts for the successful bidders to Irish Life Investment, to Amundi and BlackRock, and they are bringing already to the market scale that comes with that procurement. As a result of that scale, the procurement process has delivered investment charges for the scheme participants at lowest possible levels. And that is showing one of the main advantages of auto-enrolment, that low in charges for participants will benefit the long-term value of their fund. I've spoken to the information campaign we have done, and formally, in the next few weeks, I will formally establish NIRSA, the National Automatic Enrolment Retirement Savings Authority, so that's 6 of the 26 letters, and NIRSA is up and running. We have appointed Dermot Griffin as CEO, brings enormous experience, formerly CEO of the National Lottery, Commercial Director of Vodafone Ireland. The chair of the board will be Roma Burke, who is known to many of you in this room, who brings experience as a consulting actuary, a financial advisor, who previously served as chair of the Pensions Council and indeed served on the Commission on Pensions. And we've put a very highly experienced board into NIRSA, reflecting a very, very competitive process from people who wanted to give of their skills and of their experience to auto-enrolment and to My Future Fund. And I'm very confident that that board will ensure that the oversight of NIRSA is very, very vigorous. We have a range of recruitment processes and training, up to 40 vacancies at the moment. And again, even within that process, we've received a huge level of interest from within the industry, in the industry internationally, for people who want to join My Future Fund and want to join NIRSA. And our operational work is continuing. As we speak, there are meetings underway on a weekly basis with Revenue, with Payroll and Software Development Association, working on all of the ICT issues. And the engagement with employers of all sizes has been ongoing and will deepen extensively in the coming days and in the coming weeks. A key date for employers will be the 1st of December, because that is the day the employers portal of My Future Fund will go live. It will enable employers to provide NERSA with the relevant details that will assist them in meeting the statutory obligations that they have under the Auto Enrolment Act. And we are working incredibly hard to minimise the administrative burden for employers of all sizes. As it stands, the administrative fees for employers will be nil. The administrative tasks will be limited to that one-off task of registering on the AE employer portal, providing the payment details, and then to notifying your employees of their enrolment in the system when that occurs. Thereafter, all of the burden of enrolment, of contribution calculation, and of NERSA reporting will be handled automatically and digitally through payroll integration, which presents a significantly lower administrative burden for employers, both in terms of costs and resources, rather than operating an alternative pension scheme. My Future Fund will be transformative. Its implementation is about getting people to save for their retirement earlier and to support them in doing that. And we achieve this support element by taking away the complexity, by simplifying the choices, and by providing for significant employer and state contributions. The design of the system is aimed to encourage more workers to save for that retirement, which will be longer than it has been previously for most, and thereby a longer retirement with a more reasonable standard of living for that phase of their life. The Pension Authority is crucial to my Future Fund and crucial to auto enrolment. It will play a vital role in reporting to me annually on the operation of NERSA, and I want to thank in advance the team for their work on this. This will be in addition to the oversight of the governance structures that apply to NERSA as a statutory body, and will ensure good outcomes for all of the participants in my Future Fund. As David has said, it's not going to solve all of our pension challenges, and it's important that we continue the discussion that auto enrolment will endear in people over the coming weeks and months. It is vital that that discussion around pension awareness continues afterwards and right through. But it is a major development, and we are the last country in the OECD to implement an auto enrolment system. That's not something we need to be necessarily proud about, but the fact that we're doing it and putting it up there is a very, very significant day. There are lots of other issues as well. And indeed, the occupational and private pension system is undergoing a period of unprecedented change with greater consolidation, with improved governance standards and enhanced member protection. And these are all part of a move towards a much more robust and a sustainable pension system. Post the implementation of IR2, fewer new schemes are being established. As smaller schemes are considering their ability to meet the higher governance requirements, we are seeing an increase in the demand for master trusts and for personal retirement saving products. Master trusts, as you know, are considered to have certain advantages over the traditional single employer scheme arrangements, including economies of scale, higher governance standards, and higher levels of security, which lead to lower costs to members. It's important that those advantages are realised and that members see the value of it. The move towards greater consolidation is necessary and is beneficial, but it is not about reducing choice. Reducing the large number of pension schemes in our country at the moment will enhance the overall standards of scheme governance and regulation, but it's important that we keep choice and we keep the members to the fore of this process. The features and risks of multi-employer master trust scheme arrangements differ to the traditional single employer sponsor schemes. To reflect those risks, it's essential to introduce appropriate obligations under law on the trustees of master trusts over and above those that are required of the single employer schemes. This is particularly so due to the size and the complexity, as well as the increasing share of the Irish pension market. Those regulatory requirements will be in addition to the obligations required under IR2 and will require and include additional regulation, amongst other things, in trusteeship, in capitalisation, risk assessment, and in charges and communication. The additional obligations are aimed to further support the sound management of master trusts and ultimately to protect the rights of members of these schemes. The consolidation of pension schemes into master trusts will also facilitate enhanced supervision by the Pensions Authority. My officials are currently working in conjunction with the Pensions Authority on the legislative provisions that will be necessary that ultimately will provide for a more robust legal underpinning for the master trust regime in Ireland. My officials are also working with the Pensions Authority, with the Revenue and with the Department of Finance in developing proposals to provide for the introduction of a revised single-step pension scheme authorisation process. This is to ensure that all schemes meet the standards that are expected of them. Schemes and trust RSCs will be required to satisfy the Pensions Authority that they comply with, amongst other things, IRAP 2 governance requirements in order to obtain authorisation. This new process will establish clear standards for scheme governance and will ensure that the only properly constituted schemes operate in the market. It is important to ensure that no existing scheme members are disadvantaged by these reforms. Where scheme consolidation is necessary, membership benefits must be protected and, where possible, enhanced through access to improved governance and potentially to lower costs. As a government, we are committed to advancing the necessary legislative measures and other related tasks to provide for the legal underpinning of a master trust regime and a scheme authorisation process as soon as is possible. Scheme consolidation and higher governance standards require the Pensions Authority itself to implement a more forward-looking, risk-based approach to supervision. This approach will allow the Pensions Authority to identify potential issues before they become problems and ensure greater protection for scheme members and beneficiaries. Risk-based supervision means not only that the Pension Authority's regulatory resources are deployed where they are most needed, but more importantly, this targeted approach will improve protection for members. As the Pension Authority outlined in its recently published Statement of Strategy, good outcomes for pension savers are best achieved not just by supervision of current or past compliance, but also by addressing potential future risk to members' interests. You will hear it today. An essential part of risk supervision is comprehensive data so that the Pension Authority can identify emerging risks and take the appropriate action early on. And I know that the Pension Authority intend to collect more data from schemes and that this data will be provided more frequently than it currently is. Trustees will be required to ensure that their administration system can provide timely and accurate data in the formats that are required. I know you will engage positively with the Pensions Authority in this regard. Within the EU context, recent EU regulatory changes are bringing additional challenges to the role of pension scheme trustees and are likely to drive further consolidation in the pensions area. As we've heard, DORA, or the Digital Operation and Resilience Act, is aimed at strengthening the cyber security and digital resilience of the financial sector, including financial schemes. This will require trustees to identify any scheme activity that is supported by ICT systems and services, which will help ensure that the long-term stability and the security of pension scheme operations and protect member data and assets from cyber threats and operational failures, which are more and more common. In addition to DORA, the Sustainable Finance Disclosures Regulation, which came into effect in March 2021, seeks to achieve greater transparency regarding how financial market participants, including pension schemes, integrate environmental, social or governance risks into your investment decisions. This regulation means that trustees have to give consideration to the sustainability of underlying investments in pension funds. It introduces a broad range of disclosure requirements relating to how these decisions are made. And I think in the context of pensions, sustainability in terms of our environment and of our society is absolutely crucial to us going forward. Looking ahead to 2026, on the 1st of July, Ireland will assume the European Union presidency. Our presidency comes at a crucial time as the Commission continues to examine the effectiveness of the current IRA framework and may present an opportunity for Ireland to advance further developments which may be on the horizon. Through all of these reforms outlined, ladies and gentlemen, we are building a pension system that is more robust, that is efficient, and that is member-focused. With the advent of My Future Fund, over 750,000 workers who are today outside of any pension system will begin saving for their retirement. This is something that is truly to be noted. The success of all of the reforms I've spoken about will depend on continued collaboration between all of us in this room. Together, we can ensure that all pension savers have access to well-governed, to professionally managed pension arrangements to provide them with security and with dignity in their retirement. I thank you for your work in this area. Agus buchas go gach duine tá fartach den lá seo. This is a challenging space, but it's one with huge opportunity for Ireland as well. And we will seek to manage the challenges and maximise the opportunity by working collectively and collaboratively together. Gur míle maith.
We're now going to hear from our colleague from Europe, Matti Lepella, and he is going to talk to us about the future European outlook and its impacts that we need to be considered.
Thank you. Thank you for your kind welcome, and good morning, ladies and gentlemen. It's a great pleasure for me to be here this morning and to be following the speech of the Minister on these important topics. What I'm going to say, many of those issues have been mentioned already by the opening words of the Chairman and by the Minister. But my topic is the European outlook, so not a small topic. Pensions, of course, being very much a social issue at European level, very much up to the member states to decide. But then when we look at funded pensions, there's much room and much competence for the European Union as well. So I try to cover some of the general developments and then especially issues that are relevant in the data, in the digital agenda, and some of the sustainable finance issues as well. So there's more coming from Europe, I would say, in pensions than ever before. More initiatives, more legislative initiatives, more non-legislative initiatives directly dealing with pension funds and pensions, and then indirectly or also relevant for funded pensions. So in investment issues and then all this what we call horizontal legislation, like on digital issues and sustainable finance issues. So the landscape is very, very much. There has been already much that has been reformed. So many reforms during the last years, as you have seen, new regulation, new requirements, but much more is coming. Just to begin with, what is Pensions Europe? So we are the European level federation for funded pensions, both second pillar occupational, workplace or work-based pensions, but also many of our members represent third pillar personal pensions. We're a federation of 25 national pension fund associations, and very happy to have the Irish pension funds as a very active member of Pensions Europe for a long time. Our members invest more than 6 trillion euros in all the markets in Europe, but also very much in the US. And our members cover more than 100 million Europeans. And our role is to lobby on behalf of our members for strong, sustainable pension systems, and so that people in Europe would have good pensions. That is the aim of Pensions Europe. I would like to start with a couple of figures and pictures. We heard about the demographic challenges, that's clear, and demographics being the only exact social science, so it's not like economics. You're not guessing, you know who's alive and what is the population. It's really not going to change very quickly. And then it's been clear that the pensions, retirement income becomes a very big problem, and there's a huge amount of course, different aspects that can be considered in this. But one of the issues is the replacement rates. So replacement rates in relation to the earnings prior to retirement, and there are also very different ways of measuring this. This is from the recent report of the European Court of Auditors, the picture on the left, showing what are the replacement levels in different countries and what are they for men and women, so there are differences. And we can see from this picture that in Ireland the replacement rates are not very high. You have some countries that have no funded pensions, so really relying on social security pay-as-you-go pensions with very high replacement rates. And that poses, of course, big sustainability issues, so whether these systems are sustainable economically or financially, and then if not, how sustainable are the systems then socially? This has been known for the European Union and the member states for a long time, that with the demographic change, the sustainability of the present pension systems is not guaranteed, and thus there have been many processes to increase the retirement age and reform the pension systems. And I think in many ways, many aspects, this has been very successful, that because of the concerted efforts for the past 20-25 years within the European Union, different structures, many member states have reformed their public pension systems so that they are much more sustainable than before. And much has been put on funded pensions. Much of these reforms are depending on having more funded pensions in different forms. And there, I think, we have not succeeded. So funded pensions have not increased as much as they should have in many countries. There are many other problems with the replacement rates and between men and women. The gender pension gap is huge. So, for example, in the Netherlands, the replacement rates in relation to the earnings prior to retirement between men and women, they are not big, but the actual pension gaps are huge. Like in the Netherlands, 40% women's pensions are 40% less than men's pensions. So there are different pension policy problems across Europe that also the European Union aims to tackle in different ways. But of course, like the gender pension gap is very much a result of the labor market structures and how much that belongs then to the pension policy of the European Union. That's very much debatable. But the problem exists. Replacement rates are not adequate in many countries because of the public pensions. The social security pensions will be lower in the future, and much more is needed in funded pensions. And as we can see in the picture on the right, also from the European Court of Auditors report, there are some countries which have funded really well in relation to their GDP, but many countries and even many big economies in Europe have not. So if we look at the policies, the Draghi report, the Letta report, the upcoming work of the Commission, the ideas, the aim is to increase pension funding in Europe. So many countries should have more pension funds. They should save more in different forms, whether it's second pillar occupational or third pillar personal. They should save more. And then in addition to this, one big part of this debate is not just saving more, but investing more in Europe, in European growth assets, meaning alternative assets like venture capital, private equity, having more growth also based on investments by pension funds. That's very much a debate in many countries. also around the world, and also like in the UK, very much debated of how much pension funds should invest in the UK economy. But also in European Union, this is a debate. So getting more pension savings and then investing them in growth assets. And of course, as pension funds, we are emphasizing the fiduciary duty of pension funds, that it is to act in the best interest of the members and beneficiaries, and not to support other good policy goals as such. That growth is, of course, important, but the basic duty of a pension fund is to provide for pensions and has to consider autonomously the risk and rewards of the investments. So that is a big debate in Europe, and if we're looking at the upcoming proposals, we are expecting a big pension package by the end of this year from the European Commission. This is part of what is called the Savings and Investment Union, which is a flagship project of the present European Commission. So during this mandate, 5-year mandate, they're already 1 year into this mandate, so they need to go forward with the proposals soon if they want to get anything done. And so we're expecting a big package of proposals in the fourth quarter, maybe in November, maybe later. It's really difficult to estimate precisely, but it's coming with all these measures reforming the actual pension fund legislation, but then also non-legislative measures like promoting auto-enrollment and looking at pension tracking systems and all of that. So it's not just about pensions, it's about the European economy, it's about growth and employment in Europe as much as well. And then another picture, and this is the last picture, and these are the serious issues. These are like, why is this important? There are many different aspects, but here is just one. People at risk of poverty and social exclusion. So two different aspects. So the poverty rate, I think, the risk of poverty is somewhere around 16% in Europe on average, and then in addition is the social exclusion risk, that you don't fulfill at least 7 of the 13 criteria in social exclusion, like do you have heating, do you have shoes, things like this are in social exclusion. But we can see that these poverty and social exclusion risks are a problem in Europe, and it is of course with this demographic change, aging of the population, the problems with public finances, the problems with the sustainability of the public pension systems. This is the heart of the problem. This is where the European Union has to put emphasis to avert the risk of poverty and social exclusion increasing. That needs to decrease, and so that's, we often funded pension people will look at pension funding issues or more some technical issues with investments, but in the European Union, the social policy aspect is really crucially important in the pension in the policies that the European Union does. So putting together the financial market policies, the Savings and Investment Union, together with the social policy issues is important. And I think that this present Commission is at least trying to do this, having a more comprehensive view on pensions and their importance, and trying to have a good understanding of all the interlinkages of these topics, which is hugely complex, and different parts of the European Commission are working on these. And of course, at member state level, there are a lot of separation between social policy, financial market regulation, or economic policy, but it all needs to come together. Then moving really into these pension issues, the current trends and challenges, this shift to defined contribution is, of course, ongoing across Europe. due to costs and risks, really the defined benefit risks because of funding requirements, accounting standards, etc. They are really apparent. So shifting the risks towards individual employees has happened and continues, and the cost issue is important as well. This is not happening everywhere. The biggest European economy, Germany, is still very much defined benefit, and it's not changing rapidly. They have started with defined contribution, but very, very limited defined contribution. So Germany is still defined benefit country, but in Germany only half of the employees are covered by occupational pension funds. So they also have big problems in Germany. Also debating auto enrollment in Germany to deal with the problem that many people are outside the scope of funded pensions. So this coverage of funded pensions is a big issue in also the well-developed pension fund countries like Germany, also in the Netherlands, where you have really well-developed pension system. You have increasingly self-employed, platform-based workers, gig economy, outside the scope of the traditional pension funds and funded pensions. So even in the best pension fund countries, there are issues that have to be dealt with. But the change towards defined contribution is really strong. Defined benefit plans have been closed in many countries, or they've been merging. Funding and sustainability challenges in mature systems, they are relevant. So you have negative cash flows in some of those countries, like in Finland, where I'm from. So you have to deal with the fact that you're paying out more than you're getting in. So you have to adjust to that environment. Funding ratios and planning well the future are important issues. There are many hybrid solutions, like the Dutch pension reform. They are not going from a pure defined benefit to a pure defined contribution. The defined benefit already is a hybrid, so the employers pay their contributions, but they don't have obligations to pay more. In fact, the pension benefits when they had problems with the funding levels, they first got indexation from pensions, and then they also got pensions in payment. So the employers were not obliged to cover those. Not like in Germany, where the employers are responsible for the defined benefit pension with all their assets. So it's a very strong promise in Germany. I know that in Ireland it's much softer promise. So the DB countries and the DC countries are very different, and the hybrid solutions are like the Dutch system will not be a pure DC, it will be a hybrid. There will still be very much collectivity and even solidarity left in the new Dutch system that will be in place. Of course, the Dutch experiment is really interesting because they are changing the whole pension system into the new defined contribution system. So not the pure DC, but the DC nevertheless, and not just future accruals, but also the past accruals, and also pensions in payment will be changed into a DC. So that will be an interesting experiment. So as I said, there's many things coming, and a big part of this upcoming reform is the consultation that the European Commission just ended end of August. A big consultation on the legislative measures, but also non-legislative measures. So looking at the revision of the IRB 2 directive, which is long overdue. It should have been done years ago. Now it's coming. Also, the Pan-European Personal Pension Product was part of this consultation, but also other measures like the pension tracking system, pension dashboards, auto-enrollment. So really a big package, and now the Commission is then has received the responses and will then consider what will they actually propose, and we are expecting the proposals by the end of this year. On the pension tracking systems, which of course many countries have in place, but not all. For example, Italy doesn't have any pension tracking system. There's debate about whether it should be European or a member state level decisions on that. And I'm here presenting, as in the title you can see, Pensions Europe's views. So there are different views. This is what the pension funds have been thinking about this, that it's important that it remains a member state responsibility. But it is also important that it integrates the social security statutory pensions and also supplementary pensions, so that it is comprehensive, so you get a good picture of your actual pension entitlements. There are many challenges in the data reliability, and the cost issue is of course important for pension funds, like who is paying for this. Another initiative, and this pension tracking system has been discussed for many years at European level supervisory authority, EIOPA, already during the last mandate of the Commission, made proposals which have not been taken forward. So this Commission, I'm sure, will have some initiatives on this, but this will most likely not be legislative. They will be pushing with recommendations, with ideas, member states in this direction, that they would and should develop pension tracking systems. Pension dashboards, pension dashboard in the UK is a pension tracking system, but at the European vocabulary, pension dashboards are something different, and they are aimed. The idea is to have a macro level view of the situation in a member state in their pension system. So, what is it a good situation? Is it an alarming situation? And how that should be done, and who should do this? I think basically we, and I don't know who would not agree, that it would be a good idea to have a good understanding of what is the actual situation with your pension system. But then it gets more difficult of what data, who provides the data, how do you use the data, do you start to rank member states, which I think we would not be in favor of ranking somebody to be better than somebody else. Pension systems are very much national issues, national competencies, and member states are really different, and it's really challenging to compare country to country, because you have to consider so many different aspects, not just the pension system itself, but all the other social benefits and taxation and everything. So a dashboard, yes, a good idea, but you really have to be careful of how you go about in designing and doing that. Auto enrollment is, of course, very fashionable now. Good policy tool, has been successful, at least in increasing coverage in the UK. Whether it provides actually sustainable or decent pensions for people, that is another issue. Of course, earlier today also mentioned that it's not just enough to have auto enrollment, you have to have decent contributions to provide for actual pension. And then if and when the Commission and member states will push for auto enrollment, it is important that people have a truthful understanding of what they will actually get out of this auto enrollment system, that you don't have false promises or misunderstanding that a 4% or 8% contribution level provides for a decent pension, as it does not. So politically, that's going to be challenging. There, again, the previous Commission conducted a very good study on auto enrollment, looking at all these developments and systems around the world, but that was not used by the previous Commission. So this Commission will, and it uses that report as a basis for these recommendations that they will then publish later. we as pension funds, we've emphasized that whatever is done, it has to be flexible and it has to be decided by the member states, and it has to involve the social partners to be successful. The Pan-European Personal Pension Review is also upcoming because that has clearly failed. There's only 2 providers in Europe. The Commission sold the PEP by promising 700 billion extra savings by 2030. At the moment, there are 9 million extra savings, so it's a bit short of the 700 billion. So we'll see what happens with that. There are a lot of issues why it has not worked, and there are a lot of ideas of how it should be improved. The IRP 2 directive is going to be revised. Whether there will be an IRP 3 or IRP 2 revised, we'll see. It's important for pension funds that it remains minimum harmonization, not maximum harmonization. Prudent person principle is important. We don't need quantitative requirements in investments. Cross-border IRPs are almost non-existent in Europe. That has clearly failed. That is going to be an issue that's going to be debated. The IRP directive has a very limited scope in much of Europe, so many pension funds in Europe are outside the scope of the IRP directive, and it is clear that EIOPA and the European Commission are not happy with the fact that they only cover partially the occupational pension market. And then communication issues, whether it should be principle-based or more rules, that's a central issue as well. EIOPA, so the European Supervisor, published its technical proposal a few days ago, and that's really an interesting paper for the IRP 2, but also on the PEP. It also introduces an idea that in the prudent person rule, it should push more towards riskier assets, so alternative asset investments. But the idea is to link that legal framework to Solvency II, which is also something that I think pension funds would not be happy that pension funds want to have the IRP. I'm quite sure that they want to keep the IRP 2 legal framework as independent and separate as possible, and not to link important investment rules like investments in alternatives to Solvency II. So we'll see if the Commission picks up some of these ideas from EIOPA. On the PEP, EIOPA is envisaging a new Euro pension for the basic PEP, so simpler and better, looking at the cost cap issues and getting rid of the requirement of having sub-accounts in at least 2 countries, so improving cross-border sales and looking at costs and returns. So many new ideas by EIOPA. We'll see how much of those will go forward in the Commission's proposals, as I think it's also important that EIOPA makes the point that many of the issues that they are thinking that could be useful need to be studied further, need to be proper impact assessments. But I think it's a very good attempt to at least to have a fresh new view on this issue with new ideas. There are difficult issues like whether the PEP could be used as a workplace pension, as an auto-enrollment default. I'm sure that will be a difficult discussion if that goes forward with the Commission. There is an occupational pension stakeholder group at EIOPA. I'm a vice chair of that. There are some, like Jim Foley is a member from Ireland, and we've also have our own ideas on these issues. So there are many different actors in looking at these reforms, but this will be a really important initiative from the Commission coming very soon. But as we heard already today, the future is all about data, and there are many different European legislative actions that are relevant. The European Single Access Point coming in a couple of years' time as a platform for all digital information coming from different financial entities, free for use, including also pension fund data. That is really important. It requires digitalization of all the reporting and all the information. That is really a key issue for the European, it's part of the Capital Markets Union Action Plan that has been on the agenda of the European Union for already more than a decade. And then there are these separate pieces of legislation, the FIDA, the Financial Data Access, that pension funds also should provide data to third-party service providers to sell financial products to pension fund members. That's been debated a lot. It looks like at the moment that pension funds will be outside the scope of this legislation, but the member state can opt in to this legislation, and the Dutch most likely will opt in to FIDA. But that's not over and done with. It's still in trialogue, and it's uncertain whether the Danish presidency now can finalize these files. The DORA, the Digital Operational Resilience Act, is now in place. I'm sure many of you have struggled or been frustrated with that, and rightly so. There's a lot of new regulation on different levels, 1, 2, 3, and more is coming. A lot of costs, a lot of complexity. In our view, not enough proportionality, but that is present and that is the future. The AI Act for pension funds at the moment, still very limited use, like using chat boxes and things like that. But we are not like high-risk operations, but still we have to monitor how that legislation also develops. And we will have a digital omnibus, so a package of legislation changing different parts of different separate legislations in the digital agenda, digital legislation coming by the end of this year. And yesterday, or on Monday, the Commission published a call for evidence on this digital omnibus package, so that is very topical. There has been and there will be more reporting, so it should be smarter reporting, not just more reporting. EIOPA changed the rules on reporting from the beginning of this year, increased the threshold a bit, new requirements on derivatives, so bigger pension funds with more than 1 billion have to report the derivatives. That really has to do with the Dutch pension funds using derivatives to hedge their liabilities, interest rate liabilities, and the questions. It's really the problems stem from the UK LDI crisis, whether something like this could happen in Europe, and that really refers to the Dutch pension market, and we've been working on that. ECB has, of course, these data reporting requirements since 2019, and we are expecting a reform next year. There will be a workshop in November to discuss this, and EIOPA will also take part in that. And we are supporting and have been supporting an alignment in reporting requirements between all of these different organizations, ECB, EIOPA, Eurostat, OECD, national competent authorities, that it would be aligned and as simple and as little double reporting as possible. Because there is the double reporting, even with small differences, you end up with double reporting, which leads to costs. So one single reporting and proportionality, and to cut costs, that's really important. We are in favor of a level playing field, but on our terms, not on the terms of banks or big insurance companies, but on the terms of pension funds, which are often smaller or medium-sized. We are seen as, and rightly so, as wider financial market institutions, and expectations are rising of pension funds' contribution to the financial markets, but we have to see that this whole development fits pension pension fund landscape. Of course, we've seen a lot of changes, and that continuous consolidation will continue also because of these regulatory changes. So we'll need stronger governance, transparency, and digitalization. This is really clear that this is coming. It has already happened in many ways, and it continues. And we are emphasizing that the rules must reflect long-term non-profit nature of IRBs, and that it is about the best outcomes for members and not just compliance. And the focus needs to be on outcomes of members and not on compliance issues. Then just briefly on the other issues, the sustainable finance legislation is also in flux. There is the disclosure regulation process ongoing, maybe proposals coming next year, how this Article 8 and 9 are used. So Article 8 with the promotion of green, and Article 9 as really dark green, that you are aiming, your objective is sustainable finance objective. How they've been used and how should that be replaced with a new framework, no agreement at the moment. Also within our membership, diverging views, what would be the best fit for pension funds, and then how should government bonds, for example, be treated in this framework. The omnibus package, the first omnibus package that was published in February this year, deals with many of these important the CSRD and the due diligence, so reporting and due diligence legislation. We as pension funds have the view that it should be as simple and cost-effective as possible. But in this omnibus package, it became hugely and immediately political, that if you argue in one way, you are totally against the other views. So whether this is about dismantling the sustainable finance framework or not, that's the debate. So it's really challenging to just argue for simple, understandable, clear rules in this political debate about the omnibus. We expect the Parliament to vote on this in October or November, but that's unclear at the moment. On the CSRD, the debate is about whether the thresholds for reporting should be increased, but we are concerned of the fact that if you then increase them too much, then you exclude most of the companies where pension funds as investors would need to get information. So that doesn't make sense. And on the Corporate Sustainable Due Diligence Directive, there are many issues, and one of them is the civil liability regime. We are not in favor of deleting that from the legislation, because that would lead to fragmentation. So every country in Europe would have different rules on civil liabilities, and we think that it's better to have like minimum standards in this. But these are hugely, of course, complicated issues, all of these legislations. There are opportunities and challenges, so it's important that we work on this. Also, then the sustainability reporting standards, ESRS. So, what are the sustainability disclosures that are beneficial for pension funds? What information do we need as pension funds for the investments, and to communicating to supervisors and to members and beneficiaries on these issues? The digitalization, it promises efficiency, but you need to invest, you need skills, you need legal clarity. Consolidation must bring scale without losing trust or diversity. So that is a challenge. It's a huge, also I'm sure here in Ireland it's a huge change coming quite rapidly. So consolidation is a challenge, and we need an EU framework that enables, not overburdens pensions. And I think that building the future together is the conclusion. data, digitalization, and sustainability will define the next decade. That is, in my view, clear, and regulation must empower pension funds, not overwhelm them. So proportionality is something that we will be asking for. What it actually means is really a challenge to know, understand, and then to lobby for what is effective and useful proportionality. But I think together we can deliver secure pensions and also fuel European economy. Thank you very much.
Next, I'd like to call on Andrew Nugent, who is the Director of Supervision, Enforcement, Policy and Legal, big long title, in the Pensions Authority, and he's going to talk to us about the changing landscape of Irish pensions. Andrew.
Thanks, David, and good morning, everybody. Really good to see you here. What I'm going to do this morning is to set out where we're coming from in terms of consolidation, where we're going, and then some of the issues that we see on the horizon. And just to say, I suppose, the background to reform, government has set out the roadmap to pension reform back in 2018. We've had the Interdepartmental Pension Reform and Tax Group, and then we had the transposition of IORP 2, which brought an increase in governance requirements on trustees and also obliged the Pensions Authority to adopt a forward-looking risk-based supervision approach. So maybe just to talk a little bit about the pension landscape as is. Quite a kind of busy slide, but it's just useful to see where we are. These are figures from around Q2 25. So we've got group schemes on the DC side. We've just over 9,000 group schemes. And I'm going to get into in a little bit about where they've come from and maybe more importantly where we think they will go to. Defined benefit schemes, though, subject to the funding standard 441. We've got one member arrangements of just over 90,000, and the bulk of that 90,000 have until April 26. They were given a 5-year derogation from most of IORP 2 until April 26, which, when it was transposed, seemed a long time away, but clearly now the clock is ticking and we're down to the last couple of months of that derogation. So if we look at the middle figure, then we've active members between DC, DB, including the public sector, of 1.3 million members in pension arrangements. Our scheme and PRSA assets are at 162 billion. So there's been growth on both sides. And again, I'll break that down a little bit more to see what's happening there. Master trusts, we have 17 master trusts in the country. Just over 50% of DC assets are now in master trusts. So a lot of growth, a lot of rapid growth. Registered administrators who look after the benefit statements and the production of annual reports for schemes, that number continues to fall. It is down to 86. I think we started with something around 270 when they were introduced, and there's been a continual fall, and we expect that number to fall too. PRSA contracts, 311,000. Again, PRSA's probably an overnight success after 25 years, but a lot of kind of change and a lot of growth rapidly. So I suppose I'd say at the start, lots of consolidation. Our chair mentioned in his remarks, and I think it's important just to acknowledge the very good cooperation with providers around this whole consolidation issue. I know myself and Mary and her team have been in very close contact with providers over the last 2 years. Some of them are probably sick of seeing us, but I do want to say thank you for the cooperation on that, and you will unfortunately see lots of us between now and certainly the end of the derogation. Okay, moving on then, just maybe to look in a little bit more detail at master trusts. As I say, there's 17 master trusts in the country. We've 12 group scheme master trusts as we would see them, and 5 that cater for one-member arrangements. And these 17 master trusts, given the size, nature, scale and complexity, have been getting close attention from our supervisors and will continue to do so. If we just take a snapshot from June 2023, the membership of that Master Trust group was 315,000 members, 13.9 billion assets under management, and participating employers of 15,000. June 25, that number clearly has continued to increase, 659,000 members, 35.2 billion in assets, and 30,000 participating employers. So growth has been rapid, mainly driven by consolidation. Also, as we understand it, the new provision. So if an employer is looking to set up a scheme for their employees are going directly into master trust. So there's growth from new growth, but a lot of consolidation going into master trusts. And we've seen a huge drop off in the establishment of single employer pension schemes. So we've gone from about 14,000 a year to, I think, 2. So that's really good. And we're seeing master trusts being the main provision going forward. And I will now press the button. Okay. Just to illustrate this growth, that just shows you the rapid growth over 2 years. If I went back further 2 years, we would have started from about 2 billion of assets in master trusts. So it's very, very clear that this is an area that is growing rapidly and we think is going to continue. So to talk then about group defined contribution schemes. We, in January 23, we had 17,500 group DC schemes. So these are schemes that have more than one member, and by September 25, that figure is down to just over 9,000, reduction of 48%. Of that 9,000, most are frozen. There's about 20% of that 9,000 that are still having contributions being made. The majority are frozen with no new contributions going in. There are challenges here with this group in that 9,000 you will have schemes where there is no trustee or employer, or the employer was a trustee and has wound up. Some schemes in there have no assets, and we've been addressing those schemes. So we're looking at dealing with those. What I would say very, very clearly is any scheme in this group that is intending on consolidating but hasn't done it needs to get on with it. We have been patient and pragmatic, but I think it's fair to say that's beginning to wear thin. So if you're in the departure lounge and you think that's okay, we said we were going to move 2 years ago and we're still thinking about it, I need to tell you very, very clearly for the schemes that you advise, or if you're a trustee, you need to get on with it, get the paperwork done and get the move made. And we are beginning to look category by category in that 9,000. So those with no trustees, those with no assets, but we are going to be focusing our attention on those who just are not responding or haven't made that move. So our expectation is that number will come down, and I'll get to that later, but we still expect significant consolidation of that group scheme cohort. OMAs, one-member arrangements. So January 2023, we had 141,500 OMAs. The vast majority of those were established before the transposition of IORP2 and thus had a 5-year derogation to April 26. And I've said we are coming into the last months of that derogation. That number has reduced down to 90,000. the expectation for that number post the derogation is 0. I could say we use the acronym Z for that. I don't know, David, does that help anybody out? But our expectation is 0. As I say, the bulk of the 90,000 are derogated. We have had intense contact with providers to get ahead of any issues. We're not told that we are aware of issues relating to there being no trustee or no employer, but we're not aware of any other issues that are going to stop or halt that consolidation. So again, the message is, yes, we've been pragmatic, but let's get moving. Don't leave it till April 26 to engage. Get that engagement done well ahead of time. And as I say, our expectation for that number is 0. So that's the defined contribution and the one-member arrangements. I'm going to turn to PRSAs just to look at those in a little bit more detail. Personal retirement saving accounts, we've seen rapid growth over the last couple of years. There has been changes to tax treatment in the finance bill or the finance bills. So a number of changes have been made. But if we again just look at a snapshot from 2023, we had assets of 9 billion, contracts of 237,000. If we move to 2025, we have assets of just over 20 billion, 311,000 contracts. So what's the growth? What's driving the growth here? The growth is, again, there's probably two sources. One is consolidation. So there are those one-member arrangements that are making a decision to move to a PRSA. Clearly, there's been quite a bit of new business that's moved straight into PRSA post the changes in the finance bill. It won't be till 2027 or 2028 till we get a sense of what the long-run growth rates for PRSAs look like. So it's going to take a little bit of time, certainly post-consolidation, just to get a handle on what will the growth rate of PRSAs be on a kind of yearly basis. I suppose a couple of other things just to say on PRSAs. We published a code of conduct which went live on the 1st of August, and given the growth, clearly there's going to be more attention from ourselves in the authority. And again, just to plot out or illustrate the growth, as you can see, a rapid uptick in the value of PRSA assets over the last 2 years, majority of which has been in non-standard arrangements. Turning then to defined benefit schemes, we're seeing a reduction in defined benefit schemes, not rapid, it doesn't match what's happening on the DC side. It's probably in line with the kind of average over the last 10 years. We had just over 500 defined benefit schemes subject to the funding standard in January 2023. By September 25, that has reduced 441. And we will, in the coming weeks, or certainly within the next month, have further defined benefit stats to share and to publish. We've also, you will be aware, we've consulted on a DB consolidation. You're going to hear a little bit more about that from Gillian. She's going to give us an overview of that consultation after coffee, which I'm conscious I'm standing between you and coffee. So that's just an overview of, I suppose, briefly where we've come to from where we are, and I suppose then to maybe turn to what is our view of the post-consolidation landscape. When the dust settles, what will we be supervising and what do we see? And so master trusts, as I say, we've got 17 master trusts. There's a question I hear quite often, is that too many? I don't know. But it is possible that we might see consolidation of the consolidators at some stage. So it is likely that we might see some consolidation of master trusts. So we know we've 17. What's the optimum number for a country of our size? We're not sure, but it might be interesting to see, and I wouldn't be surprised to see some consolidation there. On the DC side, we see there being less than 500 single employer DC group schemes. This is based on discussions we've had with you as an industry, discussions with providers, trying to get a handle on how many schemes and trustees of schemes have indicated they're going to stand alone. So certainly that number is south of 500. There's also likely, and I'd say, will there be further waves of consolidation? I think we're starting to see that. So we're starting to see maybe some larger schemes that haven't consolidated up to now, reconsidering that decision and now beginning to move to consolidate. So certainly less than 500 and probably south of 300 DC schemes. OMA provision will be done through retail master trusts and PRSAs. The important point for us in the authority is the tap of new OMAs is being turned off, and we're not expecting that tap to be turned on again. We don't think they can live in the with the governance requirements, and that's something that we're keeping an eye on, and that tap is off, and we expect it to stay off. DB schemes in runoff, but still with significant assets. There's a long tail. There's a lot of small DB schemes. There's also a lot of significant schemes with large amounts of assets. So DB schemes will continue, we think, to run off, but will still have significant levels of assets. RACs, again, in runoff. And buyout bonds will probably play a part with some of the derogated OMAs. But it's important to note the government has indicated they will be ceased at a point in time. So they're in the last in their last years, and then we will have the My Future Fund, as the Minister said very, very clearly, from the 1st of January, and this will make a huge impact on the coverage issue and is a very welcome development, I think, for pension saving in the country. So I suppose our view, the post-consolidation landscape, Master Trust will be the main provider of DC provision. We will have some single employer schemes, but that number will continue, we think, to fall. Consolidation will be ongoing, and we will have DB for the significant future. And then maybe just to turn to what are the other issues on the horizon, because the good or the bad news, depending on how you view it, is the change won't stop here. So it's not just if we can live with IORP 2, that's it, because there's further change coming, which is right, given that we have trustees who are looking after people's livelihoods in their retirement. And the Minister again mentioned very clearly the introduction of scheme authorisation. So this is a really, really important part from our perspective in the authority. All schemes, all existing schemes, so Master Trust, DC and DB schemes will have to gain authorised status in order to continue to operate. Any new schemes looking to come into the pensions arena will have to be authorised before they begin to operate. So the legislation is expected shortly. We're working very closely with our colleagues in the Department of Social Protection, and we're also working with colleagues in Department of Finance and Revenue about the single-step authorisation. So tax status might hang off the authorised status. So there's a lot of work to be done, but there's a lot of work done there, and we'd expect that legislation shortly. And all schemes, although clearly the expectation is if a scheme is not able to live and operate in the governance environment, they wouldn't come forward for authorisation. EU legislation requirements. I'm getting the message, David, okay? Coffee's coming. EU legislation requirements, it's just to name check these. DORA, ESAP, IORP review, PEP review, they've been mentioned a bit, we'll hear a little bit more later. But I think the important piece to say is Brussels doesn't really sleep, so there's more coming over the horizon, and that's going to have an impact on pensions, on governance, and on the burdens on trustees. Additional data requirements, we've mentioned them, and again, just to say that there is more needed, more data and more regularly to ourselves. And then I suppose the final issue, just to highlight our supervisory focus, we're beginning to focus on the post-consolidation landscape. So we're beginning to look at those schemes that are going to remain post-consolidation, and we're moving the consolidating schemes into more management action. So we're beginning to look and say, right, we're going to move and begin to look at the categories and some of the issues there. So I suppose the overall conclusion from, I suppose, the environmental piece, there's a lot of movement, there's a lot of change, there's more change coming. If you're going to move, if you're a trustee of a scheme and you're still thinking about moving, I would encourage you to get that done quickly. And if you're a provider and you'll hear from us more on those remaining schemes. Thank you.
So we're going to continue now with the second half of this morning's conference, and delighted to welcome our colleague from our policy unit, Gillian Smith, who's going to take us through public pension authority consultations, current ones and future ones that are planned. So over to you, Gillian.
Thanks, David. Good morning, and it's great to see you all today. I'm going to briefly take you through some recent and upcoming Pensions Authority consultations. This is just a short presentation, 15 minutes before we move on to the fireside chat with John and Nuala. So briefly, we'll take a look at our legal basis and the legislative process and how that impacts consultation, or where consultation plays a role there. And finally, we look at our approaches to consultation, and with some recent and planned consultations as examples. So consultations are an important tool for the authority in a number of ways. A lot of our focus obviously is on supervision, but under the Act we have many functions, and under Section 10 of the Act our functions include to monitor and supervise the operation of the Pensions Act and pensions developments generally. So that's quite a broad remit there. We need to be able to understand pensions developments generally, and also to advise the Minister, either at his own request or on our own initiative, on all matters relating to the functions of the authority under the Pensions Act, and on matters relating to pensions generally. So a lot of our work in the policy unit are around those functions, and it's probably not something perhaps that other people might be very familiar with, is those functions. So our statutory role is that we do need to pay attention to what's happening in pensions developments generally, and to advise the Minister on them. So we do this through our day-to-day supervisory activities and our engagements. We carry out ongoing horizontal scanning for developments in domestic, EU and international pensions, and we engage directly with pension stakeholders as needed. And public consultations are also a way that we do this. So it helps us to monitor developments, to seek views and information directly from stakeholders so that we can inform the Minister as needed. So a quick look at the legislative process, because it's important to remember that and emphasise that the Oireachtas is the only body with the power to make laws. So government ministers can bring forward government bills, and other TDs and senators can bring forward private members' bills. So the Pensions Authority can really only advise and propose amendments to the Minister, which we do through working very closely with his officials in his department. So while we may run our own public consultations on pensions legislation, we do this in our capacity to advise the Minister. Ultimate responsibility for legislation lies with the Oireachtas. Also, the process for introducing new legislation is extensive, as it should be. It's not easy to introduce new laws. So even if new legislation is agreed, it then has to go through a number of phases. So there's drafting with the Office of Parliamentary Counsel, there's pre-legislative scrutiny by the relevant Oireachtas committee, and then it has to pass through the 5 stages in both the Dáil and the Seanad before enactment. So with 18 departments and 174 TDs and 60 senators, inevitably there's a capacity issue there. It's going to take time to pass new legislation. But it's interesting to note that the Oireachtas passes approximately 50 acts each year. So it's a lot of work to get any act through, but there's a high bar that has to be passed, and rightly so. Now, secondary legislation or statutory instruments such as regulations, they are a bit more straightforward. The power to enact them is delegated to certain people or bodies, including government ministers, and it doesn't have to go through the houses of the Oireachtas. And hundreds of SIs are issued each year. However, capacity is limited. The development of SIs is resource intensive, and you usually need drafting input from the OPC. The SIs also need to be consistent with and based on primary legislation, or it can be overturned by the courts. So there is a high bar to pass secondary legislation. It's by no means easy. But sometimes legislation isn't the answer. Sometimes non-legislative interventions are appropriate. For example, guidance or codes or voluntary mechanisms. These are more flexible. They can be updated more easily if needed. And part of our policy development process needs to be considering all available options, legislative and non-legislative. To propose legislative amendments, we need to believe that it is the most effective solution to the problem that has been identified. So there's a few different approaches that we take to consultations. So whether it's new legislation or amendments to existing legislation or just changes to our existing regulatory framework, consultation is an important part of that process. In some cases, we have a very clear and firm view on what changes are needed and have developed detailed proposals over a long period of time, which we then publish for consultation. In this type of approach, we're usually looking for input to help finalise the text or the approach and to identify technical or practical issues with the text and to give people an opportunity to share their views. So this approach was taken, for example, in our DC Master Trust Code consultation and on the PRSA Code of Conduct consultation. There's also what's known as a call for evidence approach, where we consult because more information is needed. We need to gather it and discuss it, and perhaps we haven't finally developed a position or a final text. And this is what we did recently in our DB consolidation consultation. And I'll talk more about that in a while. There's also a targeted consultation approach where we directly engage with stakeholders, sometimes alongside a public consultation, to gather more data or views to deepen our understanding of a particular aspect of an issue under discussion. So we might send out a survey to trustees or seek views directly from, for example, PRSA providers. So our recent consultation, as you know, was on DB consolidation, and it was a call for evidence approach. As you'll know, as mentioned earlier by Andrew and by other speakers, DC consolidation is well underway and it's likely to continue. The nature of DC benefits, it does lend to the pooling of assets of multiple employer schemes governed by a single trustee board in a manner that allows for efficiencies and economies of scale. And by contrast, the nature of DB benefits, schemes and regulation is more complex. So could a master trust model work in a DB context? And how could a regulatory framework help mitigate any potential risks to members? And so far, legislative amendments that would be needed to regulate DB Master Trust hasn't been introduced, and we believe that careful consideration is needed before we decide whether or not they should be. So the call for evidence, it was a consultation paper structured around 4 themes, posing 27 questions in total. Apologies and thank you for those that did manage to answer all of those questions. And we got some really good information and engagement on that. We began by setting out a potential model for DB consolidation, which briefly was a DB Master Trust with a single trustee board with participating schemes, assets and liabilities ring-fenced from each other. We sought views on this and information on the potential benefits, risks and impact of DB consolidation. And we also wanted to hear from those who would look to set up a DB Master Trust, how they would envisage it operating in practice. And finally, we sought views on the extent to which regulation would be envisaged at the Master Trust level versus the scheme level, as this kind of is part of the model that would rely, part of the model kind of relies on some Master Trust versus some scheme level regulation for it to work and for costs to be realised. So we're still analysing, there was a lot of detailed information in the submissions and it's an important and sensitive topic, so we are still analysing it, but we can give you some preliminary analysis, just some high level findings that are emerging so far. So we received 11 submissions to the public consultation from a range of different stakeholders. And again, thank you to those who responded. Some key themes are emerging, but it is safe to say that the views were mixed. There was no kind of consensus necessarily from the range of stakeholders, which is what you would expect on something like this. The main benefits mentioned were in relation to the reduced employer costs that could be realised, in relation to scheme governance and investment management, particularly in smaller schemes. So if these cost savings were material, it might reduce the likelihood of an employer winding up the scheme, if winding up was the plan for that scheme. Also, Master Trust could be a more straightforward way for an employer to maintain the scheme compared to having a standalone scheme. And also for some members, they may enjoy better standards of communications as they would maybe in their standalone scheme. However, some respondents did question whether significant cost savings would materialise for a number of reasons, and one of them relates to transition costs. So before a scheme would move to or decide to move to a Master Trust, obviously there are legal and actuarial advice that would be needed and a complete data cleanse to ensure that accurate and up-to-date member and benefit information is carried over. So some founders may decide to absorb some of the costs on a case-by-case basis, but these transition costs could be substantial and reduce the overall savings to the employer, which for smaller schemes or those with significant data issues could be prohibitive. Others mentioned the complexity of individual DB schemes that could make it more difficult to gain the efficiencies that could lead to cost reduction. So even if the core governance obligations apply at the Master Trust level rather than the scheme level, the level of trustee and key function holder attention that we would expect each scheme to need and to get is not comparable to a DC scheme in a DC Master Trust. There was also some uncertainty around the likely level of supply and demand in the Master Trust market for it to function and be competitive in the long term. We also did a targeted consultation. We sent a short 10-question survey to private sector DB trustees to hear their views on consolidation. We received 95 responses from schemes of varying sizes. As you can see, there were a mix of membership size and asset size. So a good selection, but definitely a lot more engagement from the kind of mid to larger schemes. So one of the questions we asked trustees was how likely, on a scale of 0 to 10, in their view, it would be that the scheme would join a DB Master Trust if it was available. So 10 would mean they're extremely likely, and 0 would mean that they're very unlikely to join a DB Master Trust. So we'll take a quick look at how the trustees responded. So the blue bar means that the trustee gave a rating of 0, 1, 2 or 3, so a fairly low likelihood of joining a DB Master Trust. The orange bar means the trustee gave a rating of 4, 5 or 6, so a bit more neutral. And the grey bar means the trustee gave a rating of 7, 8, 9 or 10, which is a strong likelihood of joining. So as you can see, the most common response was a low likelihood, and this is the case in all schemes really across the asset value categories. Overall, just 9% of trustees gave a rating of 7 or higher. Now, it is important to emphasise, and we're aware that surveys do come with a bias. So the people who respond may be those with the strongest views, either positively or negatively. And it could be that if DB Master Trusts were introduced, that demand would grow if it was deemed to be successful. But it was useful information. We got some qualitative data as well. We got some information on their future plans as well. And most of the trustees that responded, their plans were to either continue the scheme or to pursue a buy-in or buy-out pathway. So like I said, we are still continuing to analyse and discuss the submissions. A very clear and strong rationale is needed to justify any legislative amendments. And we also do need to consider if there are any non-legislative or legislative alternatives that could help DB security, benefit security in the future. Okay, so we move on to our upcoming consultations. You're asking about drawdown and in-scheme drawdown. So that's one of our future consultations. So there's a clear mandate for it. It was mentioned in the Roadmap for Pensions Reform, where it tasked the Interdepartmental Reform and Pensions Reform and Taxation Group to review the ARF and the potential introduction of in-scheme drawdown. So the group, the IDPRTG, did conclude that in-scheme drawdown should be progressed. So the authority is working with our colleagues in the Department of Social Protection, and we expect to consult to gather views to further develop our policy and legislative proposals. So again, it will be a call for evidence type approach, as in we do know there is a mandate and we clearly are supportive of in-scheme drawdown, but there's benefit really to kind of at this stage consulting and reaching out to you guys to propose a high-level model for in-scheme drawdown, who would provide it, how it would be regulated, and include topics such as the provision, who would provide it, what kind of trustee duties we'd expect, how does default investment strategy come into in-scheme drawdown, disclosure information and how that might need to change, and then member costs and whether or not drawdown-only schemes are something that could operate. So we'll be in touch later in the year on this, and we look forward to hearing your views. So feel free to get ahead and have a look at those topics, and because they would probably be the core themes that we'll consult on. And finally, we will be running a consultation on PRSA investment rules. So as mentioned earlier, the level of savings in PRSAs is at 20 billion, and most contracts and assets are now non-standard products. So we think it is timely to review the investment rules of occupational pension schemes assets and PRSA assets to determine whether a proposal should be made to more closely align those rules. So we expect to run a public consultation on this hopefully this year as well. So finally, I just want to again say thank you to those that do engage with our consultations. The extent and the quality of input is greatly appreciated. It's critical and we do value it. It's part of our Pensions Authority decision-making process. So thank you for your time today and look forward to hearing your views on our upcoming consultations.
Thank you, Gillian. Now I'd like to invite to the stage for our fireside chat, and we mentioned this at the start about data at the centre of supervision. So we're joined now by Fionnuala Ryan from our Supervision and Enforcement team, and John Getton, our Director of Strategy, IT, Data and Operations. So over to you guys.
So Morning, John.
Morning.
The subject of our discussion here is data and data and supervision. And we know that data is very important to us in the context of risk-based supervision. But before we go into all that, I think it would be helpful maybe if we talk about the systems that we're currently using to collect the data and the plans for that. So could you tell us more about the plans to replace the Pensions Data Register, PDR, if anyone is looking to select a prize, and what people can expect?
So in the prize giving mode, we'll also have something called IPS. Still not sure we're going to get the whole way through the alphabet, but we'll work on it. So good morning, everybody. It's great to see so many people here. Part of this has been signalled already through engagements that we had earlier on this year. PDR, so the Pension Data Register, is near the end of its life. We, within the authority, have been building a platform for the future called IPS, so it's the Integrated Pension System. That is due to go live in mid-part of 2026. And that will be the foundation stone for what our data is going to look like in the future. A number of things will change in that, and again, we've been engaging with all of the administrators and providers in the context of making sure the folk are ready for it. User permissions, for example, will change. The audit trails will change. The ASIs, another one, right? Annual scheme information, which we recognise for a lot of people is quite clunky, has been radically simplified. So there is a simplification piece here. The double ADRs, there's another one. So the actuarial returns and the actuarial funding certificates, which are, the process was probably of its time, where you downloaded, you signed it, you scanned it, you sent it up. They're moving into digital signatures and all of that. So it's a lot from both a UI and a UX, so user interface and a user experience perspective. This should be a lot easier for folk to work their way through. Important as well, and I mentioned the audit trail, is the responsibility for the accuracy of the submission has always resided with those who are submitting the information. However, under PDR, any changes that needed to be made had to be made by the authority. So that is a very significant change, whereby group owners or group managers, as they're going to be known as, will have the responsibility for testifying to the accuracy of the information as it goes in. They will also have the ability to change, and make changes as they go as well. So there is, I guess, a bit of a sea change that is coming with that. We have flagged it, and we will continue to provide good signals.
Yeah, and from a supervisory perspective, I think staff within the authority are quite happy to see this just as well. You mentioned there a change to the permission controls. Do you want to maybe talk a little bit about that briefly?
Yeah. So again, we're conscious, and a lot of this is built around some of the numbers that Andrew gave earlier on in context. It's a rapidly consolidating sector. Where we have user permissions. We've single logins for organizations. It's not really effective. We're not entirely certain who's sending the information in, so again, it's very much about tagging, and not in a bad way, but it's just making sure there's a very clear audit trail as to the individuals who are submitting the information. There's accountability for its accuracy, and that we have a complete look through on it. Okay.
Yep. So data quality has been mentioned a few times already this morning. Could you talk about why that is important from a supervisory perspective, and maybe give some insight into, I suppose, the European dimension on that?
Yeah. So we have, and Brendan has flagged this several times, I flagged it too, which is we do have concerns over data quality. So part of what I just said relates in part to that, so that the responsibility for the accuracy resides with those who are submitting it. But ultimately, if that's coming through an administrator, the trustee needs to be absolutely satisfied as well that the administrator has the robustness within their systems and the controls to make sure that it's flowing through to us accurately. So that becomes a basis. Good, reliable data is the cornerstone of FLIRBs. There's another one.
forward-looking risk-based supervision, all right? So it becomes crystal clear to us that the information that our supervisory colleagues in particular are looking at is reliable, and they can build on it. But it's important as well that people realise that the launch of what we're terming IPS 1.0 is the foundation, and there will be a build out of that in the context of additional data requirements. Matty has spoken to, as the Minister did as well, and Andrew noted it, the importance of the European agenda. IORPs have a reporting requirement into AOPA, and later next year we will be making sure that those data that AOPA requires. So just so people are aware, AOPA have the macro responsibility for the European pension system, and the data that they require for market monitoring, for risk monitoring, for statistical reporting. We will be required to collect that and bring it through. So later next year, we will be beginning to collect that data. We will start obviously with the larger master trusts, the larger DB and DC schemes. But again, it's important, and this is why I think it's crucial for us to signal to people early, so that you can begin planning for this. It's a format called we've actually done the XBRL, right, which is the reporting requirement for information to be submitted into Europe. So those templates, again, folk will have to be prepared to do that. We will be supplementing that or augmenting it with the additional supervisory data that we have. So we will have quite a rich data set coming in from the IORP reporting requirement into Europe. And like I said, we'll supplement that with what we require for ourselves. Most schemes would be aware that they are providing similar enough information into the central bank as part of the CBI's requirements to report up to the ECB. So there is a similarity. So one of our objectives as we go through this process is that we work with the central bank, but also to work with the ESAs as well to make sure that it's as efficient a process as possible for people.
Yeah, and that was brought up by Matt here in this moment as well.
Yeah.
Avoiding duplication, which we're absolutely mindful of. So in terms of the authority, we published our statement of strategy quite recently, and in that we outlined our intention to implement a strategy to address our data requirements.
Yeah.
So could you talk a little bit about what that means in the short term, medium and long term for the industry?
So Andrew spoke to the consolidation. So I think that's the first piece to really consider. And where our supervisory activities are moving from a very vast number of schemes down to a number which today we're focusing on is 817. And these are numbers provided by the industry, where we expect 500 defined contribution schemes, 300 DB schemes and 17 master trusts. That number, and Andrew touched on it, that number is going to decrease. We recognise that. So that's the first piece. The second piece is an authorisation process, or some people might call it a regime. So what is the data that we will require to process an authorisation? That's the first piece of consideration. The next piece that sits with that is what is the data that we require to maintain an authorisation? And thirdly, what is the supervisory data that is required in a post-authorisation landscape as well? So there's a kind of a series of steps that we go through. Related to that, and again, the European agenda is such a big agenda, but we've mentioned DORA, and people in this room and people in the authority have a view as to how DORA landed, but it's here and it's here to stay. From the European Supervisory Authority's perspective, the joint ESAs have established a DORA oversight forum, where all of the competent authorities who have responsibility for DORA are coming together. I represent the authority on that. We've central bank representation as well. And the what that says is that it's quite interesting, because people say this is not to do with pensions. It is everything to do with it, particularly when the very vast majority of IROPs are virtual financial entities. You know, so there is this reliance on external providers, and particularly to critical third-party providers. So, and there will be publications later this year in the context of who the CTTPs are, another one. And again, what's needed with that, but what are the future reporting requirements for that? Again, that will be in an XBRL format. Matty mentioned the European Single Access Point, so that's important, and the SFDR. That reporting is coming in 2028. Now, people say, well, we don't know exactly what's involved, but what we're doing as well, we're saying, as far as we're concerned, is that January 2028, the Single Access Point is earmarked for delivery. The first wave of reporting in ESAP is for the SFDR. We're already collaborating with the central bank in terms of, right, well, what does that look like from an Ireland Inc. perspective? But additionally as well, there is from 2030, there will be what is called, and we don't have the detail, is enhanced IROP reporting. So when you take all of that, we say, okay, well, what does our supervisory activity look like in the middle of that as well? How is it that we're using the data that we're then taking in to perform the most important task, which is securing good retirement saver outcomes? You know, so it's going to be quite a vast ecosystem. So if I break it down into, you know, the kind of short, medium, and long term, I think that the first piece is Q2 2026, IPS goes live. Later in 2026, we get into the AOPA reporting piece for IORPS. For the first wave, we'll have a second wave in 2027, so it'll become much more consolidated. In 2028, we will have SFDR in additional reporting, and in 2030, there will be IORP reporting, and all augmented then by the additional supervisory data that we will require from individual schemes as well, to make sure that we understand it. So that flows into good supervisory risk dashboards, that we can understand, we have the analytics for it.
Okay. And I think you mentioned that there's an exercise that needs to be done in terms of assessing the data that we have and how frequently we get that data in.
Yeah.
So how will that overall feed into the supervisory process?
So again, IPS is the foundation stone. Okay, so we get the basics. You know, and my colleagues in the authority will smile at this, but there's an expression Paul O'Connell used, I think, with the lines, which is be the very best at everything that requires no talent. You know, so get the absolute basics in first and build on very solid foundations. So that's the first piece. And anchored with that is data accuracy. Right, so we require completely accurate data. We can't be in a position where we're kind of trying to second guess and to see, is it right, is it wrong, is it reliable? So there's a huge piece with that. Frequency becomes a huge part. Now for the AOPA data reporting, just so folk know, that's a quarterly reporting requirement. Our expectation is that the majority of IORPs in that future landscape will be reporting to us on a quarterly basis, with not just the AOPA data, but also with the additional supervisory data that we will require. That data will then, and I mentioned a few moments ago, that data will flow into a supervisory risk dashboard, where in the first instance, it will be, in a very basic way, will be machine to machine, you know, so that we can, you know, there's an ease of understanding with it. We will then be able to build it up into our analytic models. What we need to be careful about is that it will take over a period of time where we can build up those kind of intelligences within those models as well, that we can control out effort for bias out. So really, it's opening up the supervisory data flow, I think, and that's going to be happening over the next year and a half to 2 years.
For the Luddites in the room like myself, can you just explain what you mean by the machine-to-machine interface?
It is, I guess, if you take, say, information that flows in today that requires somebody to do a kind of a first pass on it themselves to kind of understand it, is much more where the machine is ingesting it. it goes into a rules-driven system, and it throws out your analysis a lot quicker. So for me, it's an efficiency play. So like, it well in the context of, say, an SRP, where you're getting truckloads of documents in all different formats, so that we can get stuff in that's, it's a first pass machine read, and then you take it on up to the next level.
Yeah, that would certainly be welcome. So in terms of what this means for the industry, you've laid out quite a change agenda there, and that is going to be challenging. So how do you propose to manage that with the industry?
So we've signalled IPS quite well, I think, and it was covered in last year's annual report as well. I was very keen this year, and I guess part of it is anchored in my own industry experience, where you do like a bit of time to, get your budgets, get your change teams, get your own house in order. So I was very keen in June of this year that for all of the administrators and providers, we had in-person briefings and webinars in the context of what's actually coming down the tracks for IPS. Conscious that we haven't delivered everything yet, because we're obviously still building. But for example, over the last couple of weeks, we shared with all the providers and administrators what the revised annual scheme information, so the ASI, looks like. We are already planning much more kind of hands-on, I guess, training interventions that will happen. The majority of those will be in person for some of the larger providers, and then for others we'll be doing it on as kind of virtual events, and that will all be supported by predominantly video content. Some kind of short snippets. How do I do this? How do I do that? Rather than producing a 100-page manual, which frankly nobody's going to read. So all of that is happening. We will continue to be engaging with the sector, so that's crucial. What we'll also be doing very shortly is, it's my intention that we will have a pension data working group, and we'll be inviting for expressions of interest before the end of the year in relation to that. And that's not just a consultative body. That's where we can work with industry in a more collaborative way to kind of say, okay, what are the tools that are required? What are the technologies that are required? I mentioned XBRL, for example. How do we do all that? So it's very much about all getting to the one place together. Yep.
Okay. We would sometimes receive feedback, John, from both trustees and other stakeholders around, I suppose, a desire to see more published data. Yeah. So along the lines of what Andrew went through earlier on consolidation in the landscape, but also more granular data on, say, charges and investment returns.
Yeah.
So what do you think are our plans in that space?
So first piece, again, sorry, it sounded like a broken record here, but the first piece is accuracy. And when we're satisfied as to the accuracy of data, well then, we will share what we can. And, Andrew's information that he showed earlier on, anytime we share that information, it is well received because, everybody in this room is part of an interested stakeholder group. So as the accuracy improves, gets to the desired state, as the frequency improves, as we build out our dashboards, it's not just a supervisory dashboard, but there's also the additional dashboards where we'll be able to say, well, look, this is the size of the sector now. These are the trends that we're spotting within it. Part of that will also feed into our policy agenda. So again, back to what Gillian was saying, it helps supplement the consultations. But importantly as well, and this has been signalled by the authority previously, value for money is a critical piece, and particularly as we move into the post-consolidation landscape. And initiatives like the cost transparency standard, or similar, because there's other folk might be looking at different mechanisms, but that ability for us in the first instance to be able to challenge trustees and have good conversations about fees, charges, decision-making processes. That's the first bit. And to what extent then can we publish certain data in terms of, what do, for example, good benchmarks look like? That's where we're at. So there's no reluctance on our part to share that information. I think what it is that we just need to be satisfied as to its reliability and its frequency.
Yeah. I'm sure that will be well received when we get to that point. maybe final question, not necessarily on data, but you've been with the authority for just over a year now, I think?
1 year, 1 week.
1 week. I'm not counting. So I suppose you've worked in the industry, like you mentioned, for a number of years prior to this. So what is your impression of what the overall direction of travel for the Pensions Authority in terms of supervision? And how challenging is it going to be to achieve all that we've outlined today?
Yeah, it is. Like it's been a super interesting year for me. I think, you spend your entire career up to now, on, some people say, on the other side of the fence. People call it the dark side or whatever, but on the other side, and working within a regulated entity as opposed to now working in an entity that regulates. It's a very, very different mindset. So for me, it's quite exciting to be involved in that, but also to be able to maybe bring that outside in perspective. So that's been super helpful. Where we're going on our data journey is it's a phenomenal challenge, and that's the stuff that gets me excited, to be able to go out to affect those changes, to be able to bring efficiencies into place. So that's one piece. I'm long enough around to recognise the importance of what consolidation is going to do to the sector, but more importantly, and it's a number of former colleagues here as well, they know I'm absolutely passionate about consumer outcomes, and retirement saver outcomes, so I think that's really, really important. But one of the biggest pieces, and Matty gave us a fantastic insight on it today, is the size of the European agenda. Is really, Europe is driving the bus. And we got to be on it. There's a lot of regulation coming down the tracks from us. And what I can take from that, I guess, is that industry experience that I have, to be able to kind of translate that in and say, okay, we need time, the industry needs time to be able to put in place the plans to make sure that they can be with that. So that's been a kind of a core part to what I'm doing, but it's about bringing folk with us.
Okay.
Yeah.
You're enthusiastic anyway, so that's
Yeah, so far.
okay.
So just while the guys are getting settled there, so we've spoken a lot about, what we require from the authority's perspective. What's the data considerations that trustees perhaps need to think about from your role as the supervisor?
Supervisory perspective. Well, I think trustees definitely need good data to support their decision making, and I suppose by the nature of pension schemes, they don't always have direct access to that data. They rely on service providers typically to provide it. So they really need to be clear on what they actually need, and to engage with their providers to get that data. So, for example, how are their funds performing against their investment benchmarks? What are the range of charges that apply? So for the new requirements like the ORA, they need obviously a comprehensive data set to analyse the risks, and that will be very much underpinned by data. I think one of the area trustees are particularly engaged with at the moment is performance reviews of service providers, particularly the annual review and the critical review of service providers. So they need to think about what metrics and data they're going to use to support that analysis. And some trustees would say to us, well, I rely on my experience or my knowledge of the industry, or I have a good relationship with the service provider. That's all very important. But we would say that all has to be underpinned by the data and the evidence around it. So to sum up, I would say that really, again, it's for trustees to have a dialogue with their service providers and to let them know what they actually need. And if they find themselves in a position where a service provider can't or won't provide that data, then I think it's a different conversation that may be needed then. So welcome, Matty and Alan. So Alan, we might come to you first, because we were talking about data there up until now, and we will move on some data after this. But just from your perspective, the CBI obviously collect and analyse qualitative and quantitative data from right across the financial services sector. And you have been doing that for some time. So how have the industry responded to that increasing need to submit data, and what advice would you give the pensions industry and the authority?
Well, good morning, everyone, and thanks to the authority for inviting me here. I guess my role is head of function for domestic life insurance supervision. So I was struck by the fact that the sector that I supervise has 9 firms, and I think you have a lot more than 9. So I think the authority has a job and a hard job to pull it all together. Probably one of the reasons that I think it's useful for me to speak, I guess, is that the insurance supervision is a bit further down the track, maybe than pension supervision. So it's really post-financial crisis and the introduction of Solvency II that there was a big push on increased data requirements for the insurance sector. I guess the absence of data being considered one of the reasons for the crisis happening. So in short, I think the industry has responded quite well to the increased data requirements. I mean, the requirements are extensive. There's extensive financial requirements in the form of QRTs, which is quantitative reporting that the firms submit to the bank quarterly. But that has extended across all parts of the operations of the firms. So, it's customer information, service information about their money laundering obligations. And I think the thing that probably strikes me and that there's commonality between the sectors, pensions and insurance, is the level of new requirements coming down the track. I think Matty referenced that a lot of those are emanating from Europe now, and I think it's something that as local regulators we need to be mindful of that. I mean, to be brutally honest, at times as a regulator it can be a bit overwhelming, the level of requirements that we have to understand and adopt and take on board. So I guess having worked on the dark side previously, I fully understand the challenges that insurance industry or indeed trustees of pension schemes can experience as well. So for me, I think maybe what I would say to the authority is if you're introducing new requirements, I mean, ask yourself for what purpose? All the obvious questions. I mean, what are you going to do with it? Because every bit of data you get in, you can't just leave it there. So you're going to have to do something with it. And with the number of schemes you have, that's a lot to do. Probably ask yourself, is it proportionate on the industry? And another thing that comes up is the pacing of new requirements. Some of that is outside local regulators' controls. I mean, DOR has been mentioned a number of times. I think the DOR rollout was pretty poor, but the hands were tied, from what I could see, by the local regulators here. A lot of the timing of that was being led from Europe, and these things happen. But I think it's just to be aware as regulators that the timing of the rollout of new requirements on industry is important. And then I guess the simplification agenda is one we're very, mindful of in the central bank at the moment. I mean, with all of the new requirements coming down the track, have a look at what's there. Do you still need all of that? Can it be adapted to incorporate the new things you're looking for? Because I think as supervisors, it's important to work with the industry and listen to feedback you get from them. And what I would say, I guess, for the trustees of schemes here is it's quite easy to give out and have a moan about things you're asked to do, but probably ask yourself in the first instance, if you're being asked to produce additional financial data on your investments or information on your customer base or the members. I mean, is this data that you should be producing anyway to manage your own business and mitigate your risks and see your risks into the future and analyse trends? Because a lot of the time I think the regulator and industry should be singing from the same hymn sheet. I think all of our interests are a strong functioning sector, be it life assurance or pensions, and that customers are treated well. So I think, we're coming from the same position and remaining probably finally, I'd say, keeping, an open and engaged dialogue. So I think Gillian spoke about, consultations. I think, early consultation If the sector really has a difficulty with an obligation being imposed and it really can't see how it adds value or makes sense, early engagement from the authority and consultation back and forward, I think is a good approach.
Okay, thanks, Alan. So you mentioned simplification there, which is timely. So we know that is an objective of the EU Commission. It's one of the, 383 recommendations from Mario Draghi that David Begg mentioned earlier. So there is that, and then we're talking also about the horizontal legislation that you've mentioned, Matty, in your piece earlier. So how is all of that, the two, the objective of simplification and that horizontal legislation, I think you mentioned more is coming, like a vague threat there. How is that likely to have implications for supervisors? I'm going to come to you first, Matty.
Thanks. And this is really a crucial issue because if we look at the pension fund legislation, so IRP directive, it's minimum harmonization. It leaves a lot to the member states. Some have minimum level, some have gold-plated, like Sweden, the Netherlands have brought many requirements to the same level as for the insurance companies on Solvency II. But it's a member state decision. And so it's easier to live with the diversity of the European pension landscape with the minimum harmonization. But now, during these last years, we have this horizontal legislation, sustainable finance, digital agenda, and more is coming, which is maximum harmonization with very different legal framework, which then will bring up the national differences, and you can't deal with those in the same way at national level. So you have to deal with those at the European level. You have to have your voice heard when those regulations, when that legislation and all the other level 2, level 3, when that is put in place. If pension funds are not considered, it will not be good. The outcome will not be good for pension funds. And we've seen that already in DORA, in many others. And I know that when these new horizontal legislations and regulations are developed by all the European supervisory authorities, because the scope is all financial market participants, big banks, insurance companies, all the way down to smaller pension funds. I know that EIOPA, in defending the views of the smaller pension funds, is struggling in that debate to have proportionate rules and to have rules that actually fit the pension funds. So this is a real problem, and I think it's getting worse and worse. So a really fundamentally difficult issue. And then about the simplification, we are, as pension funds, in favor of simplification when it means that the outcome is better, more understandable, useful rules for pension funds. We are not asking for deregulation as such. Looking at the Omnibus 1 package, pension funds need information from reporting entities. They have legal requirements in ESG, in disclosing in the investments that will also be developed further, and they want to have this information. They need this information, and then the reporting companies need to provide this information. So we are asking for simplification, yes, but not for deregulation.
Okay. John, would you like to spin on that?
Yeah, I think it's an interesting part to this, and if we build much more locally for a moment, this horizontal legislation, which and there's maximum harmonization, it changes to a certain extent the skill sets that are required from a supervisory perspective. So you're not just supervising in a boxed kind of pensions world, but you're now needing to understand the implications of DORA, the implications of our implications of SFDR, and so there's a kind of a skill set there from a supervisory perspective. There's also a process piece, and also where we're issuing guidance on it as well. So there's a kind of an enhanced skill set that's needed, and that's something that we need to get used to first, before we can kind of bring the sector with us as well. So I think it's quite crucial.
Yeah, so obviously that's an issue for both ourselves and the central bank.
Yeah.
On that theme, maybe would you both of you like to talk about how the central bank and the authority are collaborating at the moment?
Kick off first, yes. So the European piece is big. It's huge. Right? So, we're both represented with AOPA. Would have been quite strong collaboration in relation to DORA. So that's a big piece. We've begun the conversation in relation to the SFDR and what happens with ESAP, because there is an Ireland Inc. kind of a response that's associated with that. We mentioned earlier on the requirement for IORPs to report into AOPA. There's quite a similarity to it now in relation to what the CBI collect for your reporting agenda into the ECB. So again, we're trying to collaborate and say, right, well, how do we make this as straightforward as possible?
Yeah, I mean, sorry, one thing that struck me was the crossover between the two sectors. So the life assurance sector that I'm responsible for supervising and the work of the authorities. So I think looking at it one way, I think I read a stat, 56% of the assets held by occupational schemes are with life firms. And then looking at it the other way, 90% of the unit-linked assets of the 9 life assurance firms, which represents the majority of the balance sheet, are in pensions business. So split, I think, roughly 60% Pillar 2 business and 40% Pillar 3. So I guess there's a huge crossover in terms of the work we do and the work of the authority. And I think the consolidation within the pension sector has only increased that as the larger life firms have set up master trusts. So I think it's really important that the bank and the authority are aligned in our objectives. And I've met Andrew and John a number of times this year to, I guess, talk through strategic supervisory priorities. And, there are particular areas where, if we're doing a thematic review on, say, customer service within the life assurance sector and issues are cropping up where there's service issues, we can share that with the authority, and similar issues could be coming up on the member side in some service from these providers to the members. We also engaged with the authority earlier in the year in relation to the market volatility. So we would obviously do an assessment within the bank in terms of life firms' exposure, and similarly shared information with the authority in relation to the schemes and whether there were any such exposures. So I guess I'd characterise the relationship as burgeoning, but open and engaged. And I think there's a genuine willingness to learn from each other, but also work together in a coordinated way to, I guess, be as efficient and effective as we can be in the interests of the life assurance firms, but also, I guess, the schemes themselves.
Yeah, okay. Masha, I might come back to you if that's okay, because you spoke earlier about possible revisions to IORP 2 and IORP 3 obviously coming down the line. And one of the areas of focus that was set out by IOPA is the transparency of member information, and in particular the idea of a pension tracking system. I know you have some experience of this from a previous life. So do you want to maybe talk about the lessons that we could take from that from an Irish context?
Yes, I think it's one of the big issues that now needs to move forward. AOPA did in my view, a very good paper back in 2021 on how these pension tracking services should be developed across Europe. There was a lot of consultation on that, but nothing has been done. And now with these upcoming proposals from the Commission, I expect that this will be pushed forward. There are tracking services in most European countries now, I would say, but they're very different. Some cover all pension pillars, some don't. Some cover only statutory pensions, some the second pillar. They're organized in very different ways. Some are government organizations, some are public-private partnerships. So there's a huge diversity in how these tracking services have been developed and how they function. But then I know that Ireland doesn't have one, and then to develop this, I think there are crucial issues to see what is the purpose with this. Is it to help individual savers to make decisions, or is it to provide an overall view of the accrued rights? So what is in the scope? Are all pensions, Social Security pensions, occupational pensions, both DB, DC, are private personal pension savings in the scope? Are other financial savings in the scope? All of those need to be decided. How is this financed? In the 2021 AOPA paper, this was one of the issues. Is this a public good, having a pension tracking service? We agreed, yes, it's a public good. Then what should be the role of the public authorities? Should it be financed by the state or not? Who pays for this? So there are a lot of things that need to be decided at national level. How do you want to develop this? And then, of course, all these technical issues, you have to have these APIs, so application programming interfaces, how you then get the data from different providers in a reliable, cost-efficient way. How do you identify yourself to the service? Do you use the European electronic ID, or do you use your existing national ID? So there's a huge amount of things, but I think there's a lot to learn from many countries. Like the Nordics have had this for 25 years. These systems, they're all different. Finland, Sweden, Norway, Denmark, they're all different, but there's a lot to learn. And also, of course, many Germans just recently introduced their tracking service. So I think it's important to develop this. And also importantly, when looking at the advice that EIOPA gave last week for the upcoming review on the tracking service, then there were many issues, but one of them was whether there should be a European regulation harmonizing the data issues. I'm sure there are a lot of details, but basically having a common technical basis for this. And then if and when Ireland develops a tracking service, I'm sure it's important to follow if that is going to go forward, and then to do something that is actually then in line with the upcoming European standards.
Okay, so a lot to think about.
Indeed, a lot to think about, that it's really important. I think that Europe will be urging member states to develop this tracking service and then to connect this tracking service to the existing European tracking service, because there's also a European tracking service that has been established. It doesn't cover many countries yet, but it exists, and this is one part of the European approach, that urging national tracking services and then combining them in the European tracking service.
Great, thanks, Matthew. I suppose it's impossible to talk about the future and the future of supervision without at least mentioning AI and digitization. So, John, could I come to you first maybe? How is AI likely to impact on the future of financial service regulation?
I've kind of a view of AI, and everybody kind of regards it as a phenomenon. It's on its 75th anniversary now, I think, when Alan Turing had his seminal paper in 1950 on human machinery and intelligence, and actuaries have been playing with it for years. It's just, they called it something different called data analytics, So I think as we grow, or it has become much more mainstream, and people are getting fixated on Gen AI, I think there are a couple of things where certainly it feeds into the efficiency, and we touched on that a little bit earlier on with the kind of machine-to-machine piece, but there is an efficiency layer first. There is some really good outcomes in the context of document summarization, document comparisons, inconsistency checkings, all of those type of things. Super important even at this stage, such as to maintain human in the loop. So that's quite important for us. But the additional data that we will be requiring, and which we will be ingesting, obtaining into the organisation will allow us to have enhanced analytics, and more. It's never going to be quite real time, but certainly much more real time than prevails today. So that's going to be super helpful. If we're building out artificial intelligence models as people read about them and see them on social media, kind of LLMs or whatever, that's a kind of a multi-year approach, because even though we're collecting relatively from an individual IR perspective, a lot of data, it's still a rather narrow data set. So you will need kind of multi-year data sets to control out bias and everything that's in there. So it's certainly something that's in our kind of short to medium term planning. And what are the kind of series of small mini bets or mini wins that we can kind of take as we move along.
Okay. Yeah. And Alan, the central bank's position on AI?
Well, it's interesting actually. I was having a drink with an American friend across the road in Perig and Peruque. They do excellent cocktails, by the way, last week. And I was mentioning this topic, and his background was fintech. But he said he's recently become absorbed in AI. And he said literally his mind is blown by what it can do. And he gave me a very brief example. It was to do with commercial real estate. But basically he said he keyed up a program in half a day, and he said it basically was cutting like 6 weeks of research time out of what commercial real estate guys might need to market a property. So I guess as a regulator, I guess our job isn't to stop innovation, and clearly it appears that there's going to be serious efficiencies and benefits from AI. But I guess the principles of what we do with anything new, be it a new outsourcing arrangement, a new IT system, the principles remain the same. That we expect the firms or the sector to do proper due diligence before rolling anything out, proper testing. And to look ahead and see what the risks, as well as the benefit, but all of the risks of something new is. So the same principle applies with AI. And, whether that's requiring human intervention at different stages, a period of testing, whatever it is, I guess we as a supervisor, our job is to, intrusively interrogate, firms and their boards to make sure that they have understood all of the risks. And they've put the appropriate mitigants in place before they roll them out. And probably worth saying that I think, regulators and authorities aren't immune from innovation either. So, I'd imagine that our own organisations will probably be looking at how AI can help us do our jobs more effectively and efficiently as well. And no doubt we should expect these standards of due diligence to be met by ourselves as much as industry.
Yeah, John's all over that. So final question maybe for you, John. We've talked a lot about data and developments and what that means for us as supervisors. But in terms of key messages from trustees going away today, what would you like to impart to them?
There's probably three simple pieces. I think understand your data obligations, right? Be satisfied, I guess, with the accuracy of your data, and be comfortable with the frequency for which it's going to have to be reported on. So I think understanding, accuracy and frequency are probably three takeaway words.
Okay. Okay, David. Thanks, Matty and John and Alan, for your insights.
Thank you very much. That was very informative. I'd like to finally call on the pensions regulator, Brendan Kennedy, to give his closing remarks.
Thanks, David. I'll be brief. I'm not going to try and summarise what we've heard today. We've heard a lot, and there's a lot of food for thought. We've had a number of different objectives for this conference, but I think our primary objective has been to raise or to reinforce your awareness of how much is going on, of the complexity, of the change, and of the the unchanging nature of the change that pension schemes are faced with and are going to continue to be faced with. And to be honest, I think we will have achieved our objective if you leave this room slightly worried. If you're not a bit worried, we have failed a bit. It's useful to think about where we came from. 10, maybe 15 years ago, the pensions landscape was a great deal simpler. Even post our 1990 Pensions Act, nonetheless, the pensions landscape was simpler. And an important aspect of that landscape back then was that the expectations of pension schemes were lower. Pension savings, this was never, I think, explicitly articulated, but pension savings and the protections and information to members was not expected to be the equivalent of other forms of savings, despite the fact that pension savings are often by far and away the biggest savings. And one of the things that is driving the change and the increased complexity of pensions and the expectations of pension scheme trustees is this belief that, or this position that if you're saving through your pensions, you're entitled to similar consumer protection that you get from any other form of saving. And in particular, we've heard a lot about horizontal European legislation. That is what drives that there is no reason that pension schemes should be ring-fenced from the obligations that are applied to other financial institutions, because the purpose of those obligations is consumer protection. So that is the landscape we live in. That is going to continue to be the basis of regulation. And that is different, and it is a higher standard than I suppose many of us have worked with. For those of us who've been in pensions for a fair amount of time, we have to recognise that increase in expectations and that there are different rules. And that has consequences for how we all do our jobs, both us in the Pensions Authority and you involved with pensions. Trustees are at the heart of our occupational pension system. In fact, from a Pensions Authority point of view, trustees are really our only focus. We focus on trustees, and then trustees engage service providers, investment managers, administrators, advisors, etc. And that's not going to change. I have always had enormous respect for trustees, for the time they give, for the fact that oftentimes trustees volunteer for a thankless job that nobody else is willing to volunteer for them putting themselves on the line, as it were, in the interest of usually their fellow employees, and most importantly, for the good faith that trustees have always brought to the job. One of the most striking aspects of Irish pensions is how little bad faith there is in the system. Yes, we as the regulator, we come across ignorance, we come across sometimes negligence, but we very, very rarely come across bad faith. And this reflects on the trustee, people who have and who continue to do the work of trustees. We've been very lucky with our trustees. But I have to say that hard work, that good faith, that devoting the time is not enough. It is something, it is absolutely necessary. But if we look at the environment that's been described here this morning, this is an environment of complexity, of detailed legal demands. So in addition to what I've described as the qualities of trustees as a collective board, trustees also need, firstly, to be completely aware of what the details of their obligations are and what the details of the obligations that are going to be coming at them are. They need that expertise that knowledge, and they also need to be very much aware of whether those to whom they have outsourced the fulfillment of their obligations, whether those service providers are doing their job. And that is very demanding, and that is one of the reasons I think driving consolidation is the pool of trustees who have the good faith, the application, but also, as I'm saying, within a collective trustee board, have the knowledge and experience in order to meet the high demands of running a pension scheme. That's not a large pool, and we need to make sure that through consolidation we use the talents of those people as efficiently as possible. And I'd also like to talk briefly about administrators. Trustees depend on administrators. Pretty much every Irish pension scheme is a virtual organisation. The trustees are the only, as it were, legal reality, and they outsource all the, let me call it, the physical work of running the pension scheme. And trustees will depend on administrators to fulfil their obligations, and these obligations, as we've seen, are growing, seems like daily. So pension scheme administration is a very, very complex environment. It requires sophisticated IT in particular. It requires high standards of delivery. And if you remember one of the slides that Andrew showed us earlier, there are 86 registered administrators in Ireland. I am not certain that all 86 administrators have the capability to meet the complexity and to continue to meet the complexity and the demands that are already on them through IORP2 and those demands that are going to increase. So I think with consolidation, we've talked this morning about consolidation of pension schemes. I believe we are likely to see further consolidation of administrators because we need to understand that providing administration for a pension scheme is a very demanding, very complex, and to pick up on the question, very expensive job. And not all the current administrators, in my view, are necessarily in a good position to do so. Anyway, I hope you have found today interesting. We will make the slides available on our website. I didn't check that, but we will make them available on our website in the coming days, which I hope you find useful. Can I thank you all for coming here this morning, for your attention and your questions. We hope you found it useful. As you have heard, we need over the coming months and years to be doing a lot more communication, because there's a lot more to communicate, and we will use lots of different channels depending on what we need to communicate. We will have different targets, but this will not be the last pension conference. We intend to have such events regularly. So thanks again, and we'll see you soon.